Welcome, everyone, to this episode of the Expansive CEO podcast. I'm your host, Hannah Chapman, and it is Thursday, September 4th, currently 2:06 p.m. Pacific time. So, this is another episode of Investment Friday. And I'm not alone this week. I've got my good friend Brad Haines, the Chief Investment Officer of Juncture Wealth Strategies, here with me as well, mostly usual. It's usually both of us. So,
Usually, but there are times where I have to step off for a little bit. So I
right where you
apologize
gotta
to everyone.
go, we're having a crazy market day and you have to trade things. That's actually his real job. So that's important and we appreciate that. So
You're
thank
welcome.
you. But how's it going? How are things going this week, Brad?
Good, good. They're actually going pretty well. For those of you who are watching the market, we went through a little volatility, but then we had some really good days in the past week and some not so great days. But today started out less than great, but ended up pretty nicely. So it's been the function of earnings, and earnings have come out, and when a company comes out and does better than they're expected in their earnings, their stock price is appreciated. However, if you come out and have less than stellar earnings and your forward guidance wasn't as necessarily as good as analysts were hoping for, the stock of the price gets punished pretty dramatically.
Yeah, and that's just to remind everyone we talked if you listened last week to last week's episode, I did talk about this because we had just hit 6,500 on the S&P 500 index, which was an all-time high. And I said these exact words, Brad, that usually when we hit an all-time high, we're going to come back off of it. We don't just hit an all-time high and then another one and then another one, right? It's not a straight line. We always back off for some reason. There's always a reason for it. Um, and
Yeah. And there's a
you know,
lot of right now the setup is we're in September, we're at all-time highs. We've got a lot of geopolitical risk. We've got a lot of the US GDP is slowing, but still doing quite well, but it is slowing. And we have the bond market that is actually could be a factor in all of this as well.
yeah. So I wanted to talk about that a little bit this week of like what's coming up. Again, last week we talked a little bit about the Fed meetings, the planned slash priced in is really the way to put it. Interest rate cuts, right? That the market predicts that the Fed will make over the next three, 3 to 6, 12 months, kind of in that whole time range, right? So we talked about that, but there are some other really important economic factors that are coming up too that I know we also need to watch out for. So what are some of those other pieces of information that you are specifically watching out for?
Yeah, so we're specifically looking out for the jobs data, how that's all coming out with private payrolls, with jobless rates, and all of that. For example, this week, the JOLTS survey, which is the job opening and layoff turnover survey, was announced, and it came in weaker than expected, but not that weak. So what I do is I use that as part of a ratio, which is how many available jobs do we have per unemployed person? And that gives me a ratio. And the long-term average is about zero point 0.7. So zero point 0.7 jobs are available for every unemployed worker. All right. Now, to put this in context, the highest it's been is 2.0. So we had two jobs for every unemployed worker. And that was back in 2021, 22, when we had that inflation spike. And we had just had a massive amount of fiscal and monetary stimulus come in the system to help us or at least help us deal with the after effects of the pandemic and that shutdown of the economy. Well, now we're beyond that. So now we're getting back to more normal levels. And right now we're just shy of one job per every unemployed worker. So we're at a really good spot in terms of the job market is weakening, but it is not weak. It's still pretty good. It's just now things are not as hot as they were a couple of years ago. For example, a couple of companies have come out and started doing layoffs. Up until now, companies have said, hey, let's not lay anyone off. we got to see how this all the tariffs play through. We've got to see how the economy, economic growth, if it continues to slow at a dramatic rate, let's hold on to these people because to get these good workers, we had to wait a long time. So we're a little hesitant to lay them off. That seems to have started to change, and there's been a couple of high profile companies come out and announce layoffs that are coming.
So, for historical context, what were some of the like in the last, gosh, what would be a good reading? In the last like 7, 8 years, what has been the lowest? If zero point 0.7 is like 0.72 is the average, what at what point were we below average?
It's a great question.
Because I know we've looked
Um,
at that chart and in our, Wednesday calls, like you bring up that chart whenever it's relevant. But yeah, it just like
I think it's always relevant.
it's all you're always worried about the jolts.
Yeah. So the jolts, the lowest it's been is 0.153.
And when was that?
That was back in just in 2008, 2009.
Oof. Okay.
So we went through, if everybody remembers 2008, 2009, the Great Recession was essentially the credit markets popped and all of a sudden everything imploded. And so uh, there were very, very few jobs for the unemployed, and that came down to 1.15 jobs per unemployed worker. And if you remember, unemployment got up to 10%
Hmm.
and and the U6, which was unemployment and underemployment, got up into the high teens.
Yeah. And that's, I mean, I remember a generation of people, graduating out of college, graduating with their masters, at that time and not like literally not able to find anything, certainly not anything in their field of study that they just, were graduating from. But even, service jobs at grocery stores or fast food restaurants, like there was very, very little happening then. And that that was the other story of that time period was people being laid off who were in their, late 40s, early to mid 50s, and then not being able to find reemployment at that time either. So yeah, that's I didn't realize it was that low though. That is crazy. So
Yeah.
by comparison, there there are portions of the economy. I think this is where some of the disconnect sometimes is because there are portions or industries in the economy that are more affected than others, right? When it comes to these numbers. So if you're in like a particular software engineering field or something, something specific, it might feel harder to get a job than that, zero point 0.9, whatever it is, 0.97 per person who's looking. But historically speaking, that's still, again, way better than what we experienced in 2008, 2009.
Yeah, that's one of the interesting things about large dynamic ratios we use to measure the economy is because it does not capture all of the micro level impacts on households and businesses in certain areas and certain industries, and job, workers in certain job skill sets. So yeah, it's but overall, job market's loosening, it's weakening, but it's still really good for the most part for overall in the U.S. economy. So again, economic growth slowing, but still chugging along. It's not doing too bad.
So, what does the JOLTS survey and the jobs numbers in general remind us again why that matters and what that does to the inflation numbers? Because those are the other things that we've been tracking, right? The CPI and the PCE, specifically, Consumer Price Index, and what's the other one?
Producer
Personal.
price index.
Hmm.
Yeah.
Um, so those measures, like again, remind us why those matter together.
Okay. So jobs can be a reinforcer of inflation. It can actually cause inflation. If you have a really tight job market, you can't, businesses can't find or employ um, personnel, employees. And so they have to start bidding up. They start paying more. And as people get paid more, what happens is it flows through to their spending. Their spending increases. And then what happens is the products and services that they are buying then become in short supply. Well, you have increased demand, shorter supply. What happens is the price goes up. And so generally that can not cause, but it can actually reinforce kind of an upward momentum in price levels. Um, Couple that with inflation, okay, because that's part of inflation. Um, Inflation's the other mandate that the Federal Reserve has is both jobs and inflation. Inflation over the past couple of years we really focused on because we got into very high levels of inflation, which have now come back down to earth. Um, So the weakening job market, where it becomes more normal, more typical of history, would indicate that the inflationary pressures from from employees, the labor market, are diminishing. Meaning there's not a lot of reason to believe that the job market's going to cause any inflation. Um, so now we have to look at other things. Okay. One of the things that is really impactful is shelter inflation. Shelter inflation it's one of the largest components of the consumer price index. It is essentially how much do you pay for shelter, for housing. Okay. And I know a lot of people over the past couple of years live in these areas that house the price of houses have gone up a lot.
Yeah.
And there's still a shortage of supply in the residential housing market. Well, what's interesting is there's an index called the New Tenant Rent Index, which essentially says, hey, if someone's going to rent, how are their rent payments looking compared to last year? And right now it's a negative 8 to 9%. So in other
Mm.
words, they're paying 8 to 9% less in rent this year than they did last year. So that effectively will translate into a much lower shelter inflation over the next couple of months. It takes about 10 months for those new tenant rent index to get become incorporated in the CPI overall. So it's something that right now, as the Federal Reserve Federal Open Market Committee starts to debate what they're going to do with interest rates this month, they have this kind of long view of shelter inflation being deflationary.
Yeah.
And so they think, oh, okay, that's part of the reason that I think President Trump and his his Fed governor Mirren, his appointee or his appointee, um, are arguing that they should be lowering interest rates now is because of the shelter inflation, which you can see basically 10 months into the future as to how that's going to impact shelter inflation coming up here.
Well, and one of the things we had talked about last time we kind of dived into um, the shelter inflation numbers, and in the inflation in numbers in general, is that shelter inflation actually makes up a very large percentage of the overall number, right? So if we're expecting 2.5% or targeting 2.5% overall inflation, like how much of that measure is shelter in general? Do you know what that is
About
typically?
30%.
That's huge.
Yeah, it's the largest component. I'm gonna look it up just so that I don't quote you incorrectly.
Always
Um,
helpful. But yeah, I mean, if we think about both ways, the way that that's affected on the increasing side and the decreasing side, or well, now if we're experiencing the decrease, that's we haven't really seen that in a while. It's been quite a few years, right? That shelter inflation has mostly been
yeah,
an upward.
exactly. So it's about 36% of the CPI is shelter inflation. So again, very, very large component of the personal consumption expenditures index, which is the PC index. That's the Federal Reserve's preferred measure of inflation. It's about 15%. So again, it's you know, we'll see.
Well, and
It's still
that's
a lot.
right. That's still a lot. And what's interesting that the kind of connection I just made in my own mind is that at least in the CPI, if it is 36% of the CPI measure, that's actually really similar to, kind of that the high end recommendation of what your mortgage or rent should be of your total income, right? So that actually mirrors that aspect. So for most people, it's the most significant bill that they pay every month as well.
Yeah, and that there's a reason for that, right? If we raised it to 40 to 45%, my guess is that would also start to climb up in terms of their because it's just uh if you can get more money then that tends to become a bigger part of your daily budget,
Yeah.
your monthly budget. So
Interesting. So, what else? What are some of the other measures that are coming out soon? So that on the calendar, so that's what I'm curious about. And then I want to talk about bonds a little bit because you mentioned that too. So we'll get to that next.
So over the next week, we've got a really packed schedule with some really important data. Of course, we've got the unemployment rate. We've got non-farm payrolls tomorrow. Those are going to be two big data points that the market's going to be keyed in on. How is this job market going? Are discouraged workers coming back into the workforce, or are they still leaving the workforce? What's that impact happening? What's the participation rate doing? We also have PPI, which is again producer price index. It's that interim amount of inflation within a raw material provider and the consumer. What kind of inflation's in the chain, in the supply chain. And then we also have inflation, CPI, coming out on Thursday, September 11th. So those are going to be some pretty big numbers, both Wednesday and Thursday next week, that the markets will most likely move on. And then I believe in a very, I think it's the week after we have the Federal Reserve meeting to determine what they're going to do with interest rates, which right now expected a quarter point cut.
Mhm. Okay, well, that kind of also lends to the reminder, and you can show that chart too. I think that's really important. The reminder that we're in September, September 4th right now, right? And September tends to be an extremely volatile month, just in general. And the historical average, Brad's looking for it. If you're watching on YouTube, or if you want to go over to YouTube, you can go see this chart. I don't know if you can zoom in on that because it's really small.
Yeah, hold on, I'm trying.
But this chart is showing the average S&P 500 performance by month. So this is average over how many decades? Does it say?
Since 1928.
So okay, so for a long time, almost 100 years of averages over time. September is negative 1.2 to 1.23,
1.25 almost.
almost.
Not quite 1.25, but really close.
Yeah, so on the negative.
On the
And
negative.
every other there's let's see, the only other negative month on average is February, but that's like negative point one, maybe point oh eight. And every other piece of the graph, every other month is positive in some way, shape, or form.
Except for February. February has an average that's just slightly negative.
Hmm.
And then September is obviously that's quite negative.
Yeah. Yeah. And so it's such an important reminder for any individual investor, for sure, right? That if September is feeling bad, right? If things are negative, if you're seeing, if it's down 5% or down 10% in September, there tends to be the panic of like, oh my gosh, like this is wiping away all of my returns for the whole year. What's going on, right? It can make you feel that sense of anxiety and panic about it. Um, but if we look into the fourth quarter, October, November, December, and into January, those 4 months in a row tend to be very positive months in the market.
Yeah, I mean, in fact, they're some of the best months of the year, which is why I try and to typically tell advisors and clients, if you have cash, excess cash going into September, more likely than not, it's going to be volatile. And so it's a good time to deploy some of that cash with some of the cheaper prices, particularly if you're looking at an economy where there doesn't seem to be anything going too wrong. Okay. And right now that's kind of where we sit. The one risk to that statement is bond yields are still trending upwards in the long term. And a lot of that is happening across most of the developed markets. And that is basically investors are trying to send a warning sign saying, hey, um, we think governments have spent a little too much. They need to kind of ratchet down the spending, that fiscal spending, get their kind of fiscal houses in order with their deficits, and then we can reduce our long-term yields on fixed income instruments. But again, I would expect that to be more tame. But the higher bond yields go, the more investors go, oh, do I really need to stay in stocks and take the volatility, or do I trim some of my stocks that are at all-time highs and buy some really nice yields in the bond market? So, I think certain investors are going through that mental exercise right now.
Well, and that was going to be my question for you. With the volatility in the bond market, um, at Juncture, we tend to take a little bit of a different approach, I think, than the firm I was at before and a lot of other portfolios. When I'm, a new client is coming and they're um, sending me the portfolio they have right now and what are their holdings. A lot of people have these mutual funds or ETFs that are a broader index of or a big basket of bonds. And so the price of the mutual fund actually moves with the bond index, right? Or with the bond market. And at Juncture, a lot of times I would say the majority of our clients, or my clients at least, we tend to use individual bonds instead.
Mhm.
And that they react, or the purpose behind that is very different from this typical, oh, we have 40% bonds in your portfolio, but they're all in a bond mutual fund or in a bond ETF. I would love for you to kind of expand on the differences there, how someone might be experiencing the volatility in the bond market between those two different kinds of clients.
Sure. So when we purchase a bond, generally clients want bonds for capital preservation and income generation. So those are the two purposes to own bonds. They also, you know, provide some source of funding for rebalancing, um, but that's not the purpose that you have them. Purpose you have them is capital appreciation or capital preservation and income generation.
Meaning
Um,
keeping this is the safe, quote unquote, safe part of
this
your
is my
portfolio.
safe bucket. I don't
Okay.
want to take too much risk. This is my safe bucket. Um, so the reason why we purchase individual bonds, if we can, is because when we buy a bond, the day we buy a bond and we execute the transaction, we lock in our yield, meaning that's the lowest return we can receive on that bond between now, if we keep it till maturity, and the issuer does not default. Okay. We lock in. That's our lowest return we can get. All right. So it's something that clients, when you have a contractual, uh, when you use the bond as a contract and you rely on that, it's a great way to do it because clients don't worry what happens in the interim. When you own a mutual fund of bonds, you don't own bonds, you own equity on bonds. And sometimes the price of that can be very different. There have been many cases in bond funds in which the NAV went down quite a bit relative to the underlying portfolio because of certain cash flow issues that will take place when clients redeem, and that NAV will almost never go back up to where it was. So if you purchased it at that high, you're out of luck. Okay. You're just out of luck. You should take the loss, write it off on your taxes, and move on. I don't like that I don't like that about bond funds. I think that bonds, again, being the safe part of the portfolio, shouldn't give you that kind of uncertainty unless you just can't afford to diversify into individual bonds, which in that case, I would veer towards some ETFs that are more passive in nature. But again, still not my favorite.
Yeah, and that's when I moved over to Juncture, so this is almost 5 years ago now. That was one of the things that was important to me that I thought was like, why wouldn't everyone do this? Because when you, like you said, when you buy a bond, and say like over the last few years, we had some bonds that were paying great yields, 5%, 6% even, on very high quality bonds that we could purchase. And so if you buy an 8-year bond in 2023 and it's paying you 5% and you hold it until 2031, you're going to get that 5%.
Mhm.
And so even if the price of the bond fluctuates, if okay, sometimes it's more expensive, sometimes it's less, right? So if the price of the bond fluctuates, it doesn't matter because you're not selling it.
Right.
The plan is to hold it and get that yield that entire time. And so you're going to continue to get that yield. And that's what creates the safety. I think that's like the safety part of it is that yield is not going to change.
Right. And what's nice is because so the client doesn't worry about the downside, price change because they know they've locked in that yield. So what happens is for the manager is we can then go in and if for whatever reason the bond has appreciated significantly, then we're able to sell it and lock in an even higher return on that bond, and then redeploy that asset and lock in again another bond that you lock in that yield to maturity. So it's something that's really interesting. The reason why a lot of advisors and managers don't do it is because it's a lot of work.
Yeah.
I mean, it takes a lot of work to manage bonds. It's not like stock, right? Bonds are very different from each other, and they're not always available. It's almost, I liken it unto a more liquid form of real estate where, real estate, you have to go find your house or your property that you want to buy, and then you have to meet with the owner and buy it from that individual. That's kind of what the bond market does. You
Mm.
just have some intermediaries in there that you don't have to actually meet with the people. Um, so it's an interesting deal. But I like the safety aspect and locking in that yield. And then if it benefits the client, we can always take the higher appreciation if it appreciates any.
Well, and the other aspect that I wanted to bring up especially in portfolios where, like, let's say you've got a 60-40, right? So you've got 60% in equities, 40% in bonds. And those bonds are, again, in these bond mutual funds, instead of individual bonds. What we've actually seen in large market downturns, for the last couple of decades, at least, if not longer than that, is that the worse the downturn is, the higher correlated bonds and stocks are. And so while they're supposed to be like, oh, if the stock market is going down, my bonds are safe, that has not been the case in many of the more recent downturns we've had. So stocks are taking a dive, your bonds are also taking a dive.
Just a just the amount they go down is less.
Right.
And
Yeah.
so
Yeah.
that's where people get that diversification benefit. That's where they hear that from a lot from the financial media and from advisors is to say, well, bonds protect you in downtimes. Well, it does, but it doesn't, right? Like you said, oftentimes they go down at the same time stocks go down, they just go down less.
Hmm.
So relative to stocks, you're right. They can, I guess, protect you a little bit, um, but not much.
Right. But that the correlation, right, is not opposite, right? We're not seeing
Correct.
a negative correlation, meaning when stocks are going down, bonds are going up.
Correct.
But if you have those individual bonds in your portfolio, even if the price drops a little bit, it doesn't actually matter if
Right.
your purpose is to hold that bond to maturity and collect that yield, that interest rate or coupon, as they call it on a bond. So if someone, and we'll wrap up on this, but if someone is like thinking about that, what, in the interest rate environment we're in, we're still in a higher interest rate environment than we have been, especially since 2008, 2009, right?
Correct.
When interest rates were dropped to right around zero and kept there for so long. Even this, 4 to 5% interest rate range is pretty high, historically over the last, decade and a half. So what could people be looking for? And can we expect to see or lock in some better bond rates if someone was able to use the strategy?
Absolutely. Absolutely. What I would consider is if someone came to me and said, "Hey, I have a bunch of mutual funds. I'm going to analyze those mutual funds. Then I'm going to put together a bond proposal or a kind of a mock-up of a portfolio that I think would be a better portfolio for them of individual bonds. And then I compare the two, compare and contrast, and give them, hey, the advantages of this versus the advantages of that, disadvantages versus each other, and then let the client choose. Um, but generally, people who buy bonds are generally more conservative. They want that piece. They may take risk in other parts of their portfolio, but for that piece, they want to have more surety, more conservative, kind of, belt and suspenders um, type risk management. And so that's what we tend to offer in that arena.
Well, again, I really appreciate it. And for me, it was a something that I was curious about even before I left. I was like, why don't we do this? Why don't we look at these things? And then, you know, almost 5 years ago at this point, I joined Juncture. I'm like, oh, well, that's how they do it. It's great. Like that to me, it makes sense to my brain. So I appreciate that.
You're
And I
welcome.
know clients appreciate it as well. So thank you. And we're gonna wrap it up there. And next week, well, I'll be on a slightly different schedule. We'll figure out when we can record because there's some important numbers coming up. And of course, if you have any questions, if you have anything that has been bubbling, that you wonder about or concerned about, have ever, questioned in the past, send us a note, send us an email. You can send me a direct message on LinkedIn or Facebook or Instagram, wherever you follow, on YouTube, and we will incorporate that into our next episode. So thanks for listening and have a great week. Thanks, Brad.
Thank you.
That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough. You are enough. And your birthright in this lifetime is to be expansive.